It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that, all in one place, in Singapore. What more can you ask? See you at TOKEN2049.
Welcome back to Real Vision. I'm Ash Bennington with a guest who needs no introduction, David Rosenberg, founder and president of Rosenberg Research. David, welcome back to Real Vision.
Thanks for inviting me back. Great to be on.
David, we were talking a little bit before the show. I know you have a very specific view on what's happening right now in the economy. You're less constructive than most on growth. Talk us through your perspective on this economic outlook.
Right. Well, I think that most economists and market pundits and even the folks at the Federal Reserve are looking at the U.S. economy through the lens of what happened last year. And of course, what happened last year was that the recession never showed up. And then everybody in their impatience and tempestuousness threw in the recession call. They basically threw in the towel on it because, of course, the view was that if the recession didn't show up in 2023, why therefore would it show up in 2024? And it reminds me a lot of that narrative in 2007 when I was at Mother Merrill. Same question being asked. The Fed took the funds rate from 1% to 5.25% from 04 to 06. By 07, no recession. And then, except for me and I think Dick Berner, who was at that point chief economist at Morgan Stanley, we held our ground. And the next thing you know, we have a recession that started quite surprisingly to the consensus in December of 07. And you heard a lot of the same things back then for different reasons, new era, new paradigm, global decoupling, commodity supercycle, Chinese economic ascension, gravitating the pull of growth around the world. That didn't exactly happen. And we would have had a recession actually without Lehman Brothers and without AIG and without Merrill going down for the count. The recession started actually before even Bear Stearns had to be absorbed by JP Morgan. So I guess that my philosophy is this. My non-belief system is that I don't believe in fairy tales. And I don't believe that the business cycle has magically been repealed. I don't think that generative AI, has repealed the business cycle any more than the internet repealed the business cycle back in the late 1990s. And once again, recession pressures were building in late 2000 and then into 2001, even with the advent and the extension of maybe the biggest technology inflection point of all time, which was the internet. And I believe that especially in an intensely credit-driven economy like the United States, interest rates matter. But the economy does reset to shifts in interest rates in both directions with lags that are long. And this has been a very long lag indeed, but it was very long back in the mid to late 2000s as well. So I'm just setting the table for you right now that what happened last year and the surprising 3% real GDP growth rate that we saw, that still has Jay Powell to this day talking about how the economy is, in quotes, solid and strong. As I said, still looking at the economy through the lens of what happened last year. What happened last year was that we had rampant fiscal stimulus at a time of a sub 4% unemployment rate. I mean, the fiscal deficit ballooned 25% last year. That never happens with the unemployment rate below 4%. But of course, we have big government in Washington and big fiscal. Had nothing to do with COVID, nothing to do with stimulus checks. It was just rampant fiscal stimulus layered on top of fiscal stimulus. So 25% expansion of the fiscal deficit. Then on top of that, double-digit growth in credit cards, which was a huge boon to the consumer, especially the low-end and mid-end consumer who tapped the credit cards in a very unexpected way last year. But as we head in 2024, there's a big hangover from that, not just from the 20% plus interest that's on that outstanding liability, which is at a new record high. But we now have the delinquency rates in the credit card space. The credit card space now is as big as subprime mortgages were back in 2006, 2007, to the point where the delinquency rate is at its highest level in 11 years. The delinquency rate is behaving as though the unemployment rate is closer to 8% than 4%. So what's happening, and you see this in the survey data from the New York Fed, that the banks are now basically forcing you to cut up your credit card. Rejections on new credit card applications going way up, and rejections on credit card limits going way up. And so the credit card story, and of course we saw, I think one big inflection point that nobody talks about was that in April, we had this very rare event, which was that outstanding credit card balances contracted in what I call consumerica. The consumer actually reduced their outstanding credit card balances, which is telling me something about frugality and telling me something about a renewed move towards increased savings as opposed to spending. That to me was a very important data point that gets very little attention. And then we had last year the last leg of the excess savings file being put to work in the economy. Now remember, Joe Biden handed out $2 trillion of stimulus checks in March of 2021. And there's not a snowball's chance in hell you can spend that all at one time. The initial spending, of course, because we were stuck at home, was on Peloton bikes and remodeling the home and patio furniture in the backyard. And then when the economy reopened, it was on experience spending, right? We had the new acronym, FOMO on Wall Street became YOLO on Main Street. YOLO, you only live once, anger spending, revenge spending. So what's interesting is that history shows that when confronted with a stimulus check, historically, the American consumer, the narcissistic American consumer, spends half of the lottery ticket and saves half. But not today's crew. Every penny got spent. Every penny got spent. And that's why Biden went $2 trillion, because his economists said, hey, you want to get $1 trillion of stimulus, you got to go $2 trillion, because half is going to get saved. But it all got spent. And of course, that spending coupled with the global supply chain problems produced that 18-month spurt of inflation up to 9% by the summer of 2022. And created all sorts of other distortions. But you see, what's important is that the San Francisco Fed just a month ago published a report that showed that more than 100% of the quotes excess savings has already been usurped in the economy. It is in the rearview mirror. And that's why all of a sudden what's very interesting is that the consumer sector now, with inflation with a 3 handle, not a 9 handle, now the consumer is telling the business sector, we can't handle today's prices. We can't. And so you see this in the beige book after beige book, and especially the May beige book. The Fed's beige book showed that there is a consumer revolt against these punishingly high prices. And that's why business right now, especially in the retail sector, and we saw this in the retail sales report, and of course in the most cyclical segments of the CPI report, they're rolling back their price increases to a small extent, but actually we're heading into a deflationary environment in the areas of the economy that are most sensitive to the business cycle. So I find that very interesting that households would choose now to say, I'm done, I cannot handle the price increases. Whereas when prices were surging exactly 2 years ago, no problem. Consumers were saying to the business sector, sure, raise the price. I don't feel it. Well, they didn't feel it because everybody's pockets, all you needed was a pulse. Everybody received a stimulus check. Everybody's pockets were bulging with the lottery ticket from Uncle Sam. So Nobody felt the price increases because we were stuffed to the gills with so much, quotes, excess savings. But that's yesterday's story. Now those excess savings are gone, and all of a sudden, oops, now I actually feel the price increases that were put into place over the course of the past couple of years. You don't find that very interesting from even a sociological standpoint that now the consumer sector is balking at these prices, and it's because they no longer have that savings cushion. And so I think as I look towards the economy, the numbers are the numbers. I don't know. I do not know how Jay Powell, with a straight face, can go in front of the public, as he did at the press conference after the last meeting, and say that the U.S. economy is strong and solid when the Fed's own beige book, which has been around for 60 years, comes out every 6 weeks and provides the most widespread informative narrative on the U.S. economy by industry and by region, that it would characterize the economy last month as being the pace of economic activity as being modest and slight, is not strong and solid. But you see, everybody has bought hook, line, and sinker into the narrative that you talked about, which is, the economy is strong. And that's looking at what's happening through the rearview mirror, which is exactly what was happening even as we were moving into the opening months of 2008. Even after Bear Stearns was absorbed, the consensus right into the summer of 2008, soft landing, no landing, soft landing, everything's okay. And yet when the NBER announced the recession in December of 2008, and of course, because what they do is they wait for all the revisions. And now we're seeing all the numbers, the housing start numbers, the retail sales numbers, the employment numbers that are consistently revised negative. The NBER waits for all the revisions. We know for a fact from the QCEW that last year non-farm payrolls were overstated by 800,000. But it doesn't matter, because if non-farm payrolls coming above expectations on a Friday, the markets go bonkers to a completely flawed statistic, and primarily this cycle because the response rate from small business has been so low post-COVID. So we're getting a really historical gap between the first release, for example, of non-farm payrolls and the third release. But you see, Ash, by the time the third release comes out, everybody's forgotten about it. And if you are under the consensus on, say, a February non-farm number, but it blew up in your face, 3 months later when the revision comes out, and what do you know? I was right after all. I got killed that day, but I was right. But who cares? The revisions are squarely to the downside in all the indicators. That's what happened in 2008. So the NBR aren't a bunch of lazy dummies waiting there for the recession call. But what's interesting in December of 2008, and it's instructive, was that they dated the start of the recession to December of 2007. December of 2007. Oh, that took a lot of people by surprise, but post-revisions, yes, it made a lot of sense. So look, for all we know, and we're looking at these consistent downward revisions to the previous data, the recession may already be starting, okay? We've been in a recession pretty well in the housing market, in manufacturing, and now retail sales in volume terms. And by the way, the wholesale trade market, which is even bigger than retail, both contracting 2 quarters in a row. And I'm there wondering, where is this narrative of a strong economy coming from, except for the fact that everybody's looking at the situation by gazing through the rearview mirror. So we're down to 1.3 on first quarter real GDP. It was 1.6 down to 1.3. It probably gets revised down again, looking at the revisions that we're seeing. And it looks like first quarter, with all deference to the Atlanta Fed, at 3.1, that number will come down. But the St. Louis Fed nowcast is at 0.9, and that's my number is much closer. So we're basically at levels of growth. It's right now a 1 handle for 2 quarters in a row. That in the old days when I started in the business in the mid-'80s, let me tell you something. If we had back-to-back quarters of 1%, what we called stall speed back then, I would be getting asked questions, when's the recession starting? Nobody's asking that question anymore because of last year's experience. But the pace of economic activity is weakening, and it's gone from a 3 handle to a one handle. And then the question we'd have to ask is, so what exactly is the catalyst? What is the catalyst that's going to cause your reacceleration and growth? What is it going to be? Are we going to get a revival in credit card extension as we had last year? I don't think so. Is fiscal policy going to be as stimulative this year as last year? No, I don't think so. And is there going to be like some new stimulus package to give people cash in their pockets? Because last year, one of the big stories was the last leg of the excess savings file being put to work in the retail sector. That clearly is not happening. So that's my sense, is that whether you want to call it a classic NBER defined recession, well, time will tell. But the economy is growing below trend. And that's what's really important from an inflation standpoint. That's what's important and you don't need a recession to cause a further disinflation environment from taking hold. And I'll tell you why, because when you're forecasting as an economist any price, you need two curves. You need a supply curve and you need a demand curve. And that's why you want to talk to the economists more than just because we're a bunch of fun-loving people. We can predict prices of everything from copper to gold to real estate to the economy. And the price level in the economy is dictated by the movement and the shape of two curves, very powerful curves. One's called aggregate demand, one's called aggregate supply. And it behooves the economist to be on the right side of the call here. So aggregate demand is GDP, spending. It's all about spending. We're down to a one handle. Now, the Fed's got its forecast that we're into a 3-year period of 2% real GDP growth. A perfect world. Well, we'll see about that. Right now, we're down to around 1%. But the supply side of the economy, which, by the way, Powell had been talking about, but all of a sudden, because they don't want to cut rates, he's not talking about the supply side. The supply side being basically labor force, participation, and multi-factor productivity, okay? That's running well north of 3% right now. The supply side of the economy, which was a principal source when it was basically decrepit back in 2021, 2022, was a source of inflation at the time that demand was booming. But the supply side is running over 3% growth at a time when the demand side is already barely above 1. Let's even assume, we'll be charitable and assume that the Fed's got it right, that we're just going to have perfect Goldilocks 2% GDP growth. You see, they forecast GDP, but GDP is just demand. They don't forecast what their estimates are of the supply side of the economy. But even if they're right on 2% spending growth or GDP growth for the next several years, if the supply side holds in, as I expect it will, you're going to have this gap between these two curves, aggregate supply, aggregate demand, that's going to force inflation down over time. It won't be a straight line any more than it was a straight line in the opening months of this year. But everything tells me, looking at the supply and demand of the U.S. economy, and if you don't have a supply-demand framework, then don't bother having an inflation forecast. It's telling me that the pressures on inflation are going to be subsiding, that the decline in inflation, headline and core, is going to surprise a lot of people by the end of this year and in the next year. So my highest conviction call basically is that the Fed will be cutting rates much harder and faster in the next year than what's priced in. And the Treasury market is going to end up delivering equity-like returns between now and this time in 2025. That's my view. I'm sticking with it.
You want to unfuck your shit?
This is live.
Yeah, that's being recorded. Hey, listen, if you want to unfuck your future, then come and join us in the Real Vision community. Incredible platform, amazing content, some of the smartest people in the world, and amazing tools. And guess what? It'll cost you nothing. Come to realvision.com. I'll see you there, and let's help you unfuck your future.
David, very sobering remarks as you frame out your view of this economy. I have a number of questions for you. Let's just dive in here. Where do you think trend growth is right now in the economy?
Well, trend growth right now, if we're talking about the supply side, is north of 3%. I know the Fed is way below that number, but that's what the numbers are right now. That's the result we are going through. There is this is actually not even AI related yet. We know AI is going to have productivity benefits. We just don't know to what extent. A lot of this is really coming from COVID and the fact that, in a perverse way, that's what the lockdowns did, was they forced everybody to digitize and automate their business. So it was actually totally unnecessary and provided tremendous distortions that we see to this day, especially in office real estate. However, it forced a lot of old economy businesses, especially in retail. And in fact, that's where the biggest productivity gains are coming from, believe it or not, is not from technology or manufacturing. It's coming from the retail sector. Because either you took on Amazon's model or you went bankrupt. That was the choice. So right now we're seeing tremendous productivity growth, and then we're seeing people coming back in. You see people are coming back into the labor force. Why, pray tell? Because they don't have the savings cushion anymore. And they don't have the extended unemployment insurance benefit anymore, so they have to come back to work. So the working age prime adult participation rate has gone back to a 2-decade high. So you're seeing all the stuff the Fed was all concerned about 2 years ago. Don't you remember the great retirement theme? Oh, everybody's going to retire. We have all this money in our pockets, our 401ks, and look what's happened. How come nobody talks about that new era? The great retirement theme. Nobody talks about that anymore because it doesn't exist. And so you've got the labor force expansion coupled with productivity. It's telling me that the trend growth in the economy, trend means aggregate supply, running over 3%. That's actually very bullish. However, it would only be inflationary if demand was running over 3%, which it no longer is.
So let's talk a little bit about the disconnect between the productivity gains we've seen on the supply side and what we're seeing on the side of aggregate demand. Frame that out for us.
Well, it's like I said, aggregate demand is spending in the economy. And no doubt we still have government spending going on. But interestingly enough, business CapEx has been fairly anemic. And everybody talks about, look at this earnings boom. Well, there's no earnings boom. Earnings are going up roughly 6%. And outside of the Mag 3, we were Mag 7, then we were Mag 5. Maybe we're Mag 1 now. But the S&P 500, 497, earnings are actually negative year on year. And business CapEx follows earnings. There's not been a CapEx cycle. Of course, we hear about these order books for generative AI chips going through the roof, but that's not the only thing that goes into the economy. Housing might only be a 3.5% chunk of GDP, but it has all these powerful multiplier impacts. Look what home sales are doing. Look what housing starts are doing. This is the most credit interest-sensitive part of the economy, and housing has powerful spin-off effects. And it's heading right back down again after some, really what was an upward blip or noise in the first quarter. It's heading right back down again. And the consumer is 70% of GDP. And there's some things that just never go down in a downturn. Education spending, utilities, food at home, health. There are things they don't cut back on, but the cyclical parts, the cyclical parts, the stuff you don't need, they're starting to crumble. And of course, the retailers are telling you that the same thing. So you're seeing cracks emerge in the consumer sector, broadly speaking. Housing is back in a downturn. There's precious little growth in capital spending. Commercial construction is under disarray. And that's really a good chunk of your GDP. Net exports, what's going to happen there? Strong dollar, crimps exports. You still have a squishy, soft global demand picture. India is very strong. Some parts of the world are okay, but Japan is bouncing along the bottom. I suppose that's probably relatively good news for them, but Japan is bouncing along the bottom. China is in a whole lot of pain from their property and financial sector morass, and they're in a structural slowdown. Obviously has an impact throughout the rest of Asia. So it's hard to say where the global growth is going to be to make the export sector. The export sector again in the United States, very strong multiplier impacts, not happening. And then we got the strong dollar, which is another tourniquet on exports, hits back on manufacturing. So I'm trying to find the needles in the haystack. Where's the reacceleration story coming from? Last year, the reacceleration story really came from the massive unexpected fiscal expansion, the fact that nobody saved anything from the Joe Biden lottery ticket. All that money got spent last year. That was a big surprise. And this credit card boom came out of nowhere. None of that's happening this year. So, that's really the outlook on the demand side. In a word, I won't even go and say recession. I do not even need a recession to get my inflation call right. I don't need a recession to get my interest rate call right. A recession for those calls would just be cherry on the cake. I just need to have one word on the demand side, which is anemic. And that's really where we are. And I don't see the catalyst for reacceleration. The risk to my forecast is that this productivity uptrend proved to be something temporary. Well, we'll see. I'm not convinced that that's the case. Or that the labor force growth is going to roll over. But I think that as times get tough, people come back into the labor market to look for a job. And we see that in the jobless claims numbers. Take a look at the backlog of continuing claims is telling you that it's getting tougher and tougher for the ranks of the unemployed to land a new job. So what's going to happen is that the unemployment rate, which is not derived from non-farm payrolls, it's derived from the household survey, got as low as 3.4. Now it's at 4%. And it's not the level of the unemployment rate that determines the contours of the business cycle. It is the change. It's the change. We're up 0.6 of a percentage point off the lows. And as the unemployment rate goes up, what happens is that with a lag, wage rates start to decelerate. So that's going to cut into consumer spending growth at a time when the consumer sector is going to be focused more on rebuilding their depleted savings rate. So all roads lead to, if it's not a recession, anemic growth that will come in below the trend of aggregate supply. That's all I need. Now, if for whatever reason aggregate supply growth implodes, then my disinflation thesis is going to be at risk. But right now, things have flipped from a couple of years ago. A couple of years ago, we had very anemic aggregate supply curve, booming demand. But the roles have switched. Now we have anemic demand, and actually the supply side of the economy is actually pretty robust. We just got the industrial production numbers. And if you're taking a look at capacity growth, the capacity in the industrial sector in the United States, capacity is running 1.5% year over year. Let me just tell you, that is a 20-year high. So we are actually building more productive capacity. Is that bullish? Yes. And it'd be even more bullish if we could actually get the demand side to match the supply side, or if you're an inflationist, demand to go above supply. But right now, we've got role reversal here, where the supply curve is actually rather dynamic. The demand curve is the one that's faltering. That is what leads to the disinflation / deflation call that just brings on diversions of laughter whenever I bring this up. Then I have to wheel out the whiteboard to actually show people what it is I'm talking about. But that's what I'm talking about.
And it's literally, David, it sounds like it can be boiled down to those two lines, AS, AD, and the gap between them. What does that gap suggest to you in terms of where you see inflation headed? How low can it go?
I think that headline and core will be heading down to around 2% by the end of the year, so it'll be a target. And that's what's funny is that the Fed's all telling us, we're not cutting rates till the end of the year. Whereas at the end of last year, Powell was very vociferous when he said, we don't have to wait to get to the 2% target before cutting. Of course, understanding that inflation is a lagging indicator. He said, we wait till 2%, it's going to be too late, especially when you consider how far above the funds rate is even higher than this newly guessworked 2.7%, 2.75% neutral funds rate. Nobody knows where neutral is, but policy is still tight. He even says policy is tight. Policy is restrictive. Inflation will
Just to
be
explain
down
that to people,
towards
you're talking about
2%.
it's currently above the neutral policy rate. So
Yeah, by 250 basis points. So there's a long road to hoe just to get to neutral. And they're not going to be stopping in neutral, especially if we get a recession. However, I think that in answer to your question, I think inflation will be down towards 2%. Nobody believes it. That's what our analysis shows. It's just based on analysis. It's not an opinion, not a humble opinion, not any sort of opinion. It's just the math that falls out of the work that we've done. And then we recede further to around 1.5% by the end of next year. So when you're asking me, well, you're still bullish on treasuries, yeah, I work in a business where your assumptions drive your conclusions. If my inflation assumption came to a different conclusion, I wouldn't be bullish on treasuries. But this is what falls out of the analysis.
Well, David, that brings me exactly to where I wanted to go next, which is the implication for asset prices on this. As we're having this conversation, S&P 500 broke above 5,500 for the first time, led by NVIDIA. That rally continuing. Let's talk a little bit about your perception of risk asset prices and what the hypothesis implies for where that's going to be going over the next 3, 6, 12 months.
Well, I have the benefit of producing economic and financial market research, so I don't have to run money for a living. And I feel sorry for investors out there that don't own NVIDIA. It's like how you felt as a fund manager, not owning Cisco back in the late 90s, or if you were in Canada, God forbid, not owning Nortel. So it's tough. It's tough. It is really a tough market. It's a tough environment to run money, because to meet or beat the index today, much like in the late 90s, and the late 90s was not just about .com. People say, well, but the .coms made no money. They had no business plan. These companies today have money. They have business plans. No, a financial asset bubble is a financial asset bubble. And the reality is that everything is getting tarred and feathered by AI today. Even the utility sector is being re-rated because of generative AI and having to, revamp the power grid in light of all the data centers that have to be built and then powered up. And back in the late 1990s, it was Dell and it was Cisco and it was Microsoft. The tech sector, broadly speaking, .coms or not, still went down 80% from peak to trough from 2000 to 2003. And then it took a long time for these stocks to recover. You couldn't have sold that story back in 1999 or 2000. My sense about the stock market today is very interesting. We have tremendous concentration risk. You have 3 stocks that command 20% of the index. And if you don't own those 3 stocks, your clients are yelling at you or they're pulling out their money. So it's creating extra concentration risk because most fund managers are too scared to let go of these high flyer mega cap names. And on top of that, we have unprecedented flows into passive investing ETFs. And when the flows go into ETFs and the index buying, because it's easy to do and a slow cost, the funds themselves, the indexes, they have to buy these names. So it's making the bubble get even bigger. How can it not be a bubble? NVIDIA is a great company. Cisco was a great company. Microsoft was great. All these companies, and they were .coms, late 90s, were great companies. They survived the test of time. They were lousy stocks for about 3 years. But I'll just say to the point that we have tremendous concentration risk in the market, okay? Valuations are excessive. There's the equity risk premium has been vanished. And that's a bit of a problem. I like to tell people I like to invest in the stock market with a tailwind, not a headwind. And valuations aren't a timing tool. We have a 21, 22 forward multiple at a time when money market gets you over 5%. The 10-year gets you 4.3%. I would just assume go into a single A corporate where there's hardly any default risk and you're picking up a very nice coupon without a lot of duration risk, there's a lot of alternatives, right? At least nobody's saying TINA anymore. There is an alternative, but the equity market continues to make new highs, as you say. But the price advance is so far outstripping the earnings growth. It has me concerned. But I hear so much baffle gap on podcasts, webcasts, on Bubble Vision. It's an earnings led stock market. How is that possible? Stock market's up 30% in the past year. Earnings are up 6%. Now, if the stock market was up 6%, I'd say absolutely right. It is an earnings led market, but the price of the market's gone up fivefold next to what earnings are doing. So it's really been a multiple driven, and actually with no benefit from lower interest rates. But we have tremendous, what John Maynard Keynes called animal spirits. So we have tremendous confidence and ebullience, momentum and sentiment are off the charts. And let me tell you something, a lot of investing is purely psychological. It is not always fundamental. And the fundamentals ultimately went out, but that could take some time. And I would just say that I'm not going to say the fundamentals are weak, but I am going to say that it's a very bifurcated market and the prices have gone way beyond the underlying fundamentals. That's my principal concern. And doesn't mean that there's not thematics out there. We know that we're heading into global skirmishes. Military spending is going up everywhere. Defense, aerospace, to me, is a secular growth. You could argue that utilities are probably secular growth. And there are other areas like cyber security that's got visibility. So I can see needles in the haystack, but frankly, I'm a little nervous about the market as a whole. I think it's probably best right now to be more thematic in your investing than buy the indices at these inflated multiple levels. And then we can look around the rest of the world. 60% of the rest of the world is, Japan has got secular tailwinds. India, notwithstanding the fact that Modi's got to share power right now and build a coalition, but I think that it's the only area in the world where you're seeing real bona fide productivity-led 8% GDP growth. India, Japan, I think that lots swaths of emerging Asia and even parts of Latin America are looking pretty good. But I talk about this with my clients, and everybody's got home bias. People don't look at the stock market. They only think the S&P 500 is the only stock market without realizing that there are other parts of the world that actually command much better PEG ratios and much better equity risk premium. That basically I feel that the risk reward profile is better. So I'm trying to encourage clients to take their profits, count your lucky stars, take your profits in the US and rebalance into other areas of the world. That to me is just prudence.
By the way, let me double click on the Cisco joke for the 22-year-olds watching who don't have the gray hair that I do. Never regained its high of, I think, about 77, going back to 2000. So essentially 24 years underwater. If you bought at the high, I think it's trading at about 46.40 right now on my screen. But let's talk on some of those thematics because you have some areas that you're constructive. First, let's talk a little bit more about the equity sectors, and then we can talk a little bit about international and the split that you see between fixed income and equities from portfolio positioning perspective. You mentioned aerospace and cybersecurity. Talk a little bit about those spaces and others that you see in terms of sectors that are poised to grow.
Well, I said aerospace defense. There's certainly one company and that's part of aerospace that you might want to shy away from.
I wonder which.
Defense spending is going up in areas like Japan, Germany. We know what China's doing. And the U.S., unfortunately, in this massive 7% deficit GDP ratio, we won't have a choice but to ramp up military spending in the United States as well. So that area's got visibility. I really like for the cycle, especially given the changing nature of the consumer. And I was saying this even before the retail sales numbers started to go down, and they're going down now. They're shrinking. even before then, I was saying, look what's happening here. You are seeing a real shift in patterns, and a shift in patterns that takes place usually before recessions, and that is trading down. And you see this in the consumer spending data, buying more chicken, less veal, eating at home more, eating out less, cutting back on recreational services, spending more time at home. You're hearing stories about Lamborghinis being parked outside the local Walmart. Even the higher end is starting to trade down.
Right.
Private labels over brand labels. This is all happening. By the way, it's all in the beige book as well. All these shifting consumption patterns towards, in one word or less, frugality. So I want to own sectors that have a very low GDP elasticity. I want to own the areas where people need to spend, not what they want to spend. So I don't want to be in consumer cyclicals, but I don't mind being in staples. I don't mind being in the drugstores, the pharmacies. I don't mind being in the chain stores, the grocery chains I'm talking about. But I'm not so keen on, say, apparel. I'm not so keen on autos. I'm not so keen on building materials, or even the home builders. That day will come once we start to see rates go down a lot more, but the Fed is biding its time. So I want to own really the staples. I have no problem with healthcare. I see secular growth in the healthcare industry. I sort of poke fun at utilities being really all of a sudden a beneficiary from what's happening, with AI. But there's other things going on. And climate change is one of them. And you're asking me before what the weather was like in Toronto when you fell off your chair when I said it's like 90 degrees. There's no area in North America that can afford to have recurring blackouts. So I think the utilities are being re-rated, not just what you want to own. I used to call utilities bonds and drag because of their attractive dividend yield, but utilities are going to get re-rated for as a growth area. So you see, there's even this alleged perma bear. I'm not a perma bear. I'm an idea generator. It's just that people have to read my material. But there are areas that are not sexy beneath the veneer that I would be focused on. I'd be focused more maybe on sector ETFs or just buying these stocks individually than right now buying the S&P 500, even understanding that it costs 5,500 because of 3 stocks. Okay. But that's what I say. I'd be a lot more thematic in my thinking. Investing shouldn't be this easy. It shouldn't just be, hey, I'm buying I'm buying the Spider ETF and I'm making a gazillion dollars. Investing is not supposed to be this easy. So I say that, get out your pen and paper, your calculator, and you'll see that there are some segments of the market that look pretty good to me. I think that I am in basically capital preservation mode right now as everybody is chasing the bubble. I'm in capital preservation mode and the preservation of cash flows. And so, of course, the utilities provide you with that other element, which is dividend payouts and dividend yields. Look, there's another, we didn't talk about gold. And gold, people say, well, right now the US dollar is strong, for now. But when, you're seeing central banks cutting rates, Bank of Canada, we've seen the Swiss National Bank, the ECB, the Fed will be playing catch down on rates. And when it does, and this might be more of a story for the end of this year, but some of the plan for 2025 is a reversal in the US dollar. By the way, that'll be good news for commodities, generally speaking, but especially for gold, which is priced in US dollars. And real rates coming down is a real tailwind for gold. But you don't have to buy gold. People say me all the time, but it doesn't provide a cash flow. Understood. So buy the gold mining stocks, which are not only cheap relative to the stock market itself, but cheap relative to where the price of gold is. By the way, the gold mining sector pays out a 1.7% dividend yield. So that's not too bad in a disinflationary declining rate environment. So that's something else that's on the top of my list as far as equity sectors are concerned.
David, I want to ask you, since you mentioned obliquely this idea of passive indexation. Talk a little bit more broadly about the impact of passive indexation in markets, what it's done in terms of potential distortions in risk allocation, capital distribution. What does it mean for markets writ large?
Well, as I said before, when these flows come into the index investing, it used to be in the old days, people just buy stocks, and it would just be that, well, I'm buying these individual stocks, and other people are selling other stocks, and the direction of the market is really made on, which stocks based on their market cap are going up more than the ones that are going down. And it was an exciting market. This is really unprecedented in terms of the inflows into index funds. And it's telling you about the growing dominance of the retail investor, thinking that's the overall stock market is a get rich scheme without realizing that the market moves in cycles. But you see what's happening is that it's such a concentrated market right now. 3 stocks with a $10 trillion market cap combined, 20% of the market. And what happens is that these inflows come in and the index investor has to buy more and more of NVIDIA and Apple and Microsoft. And these are great companies, make no mistake about it. But I don't really think that NVIDIA, with whatever their price to sales ratio over 50, I don't know. Like, that's pretty nerve wracking to me. But these index investors have to buy more. So the bubble gets bigger. And at what point does the bubble burst? Who knows? What did the Fed cause the bubble to burst in 2000? No. I mean, they already finished tightening early that year. Everybody believed in a soft landing. It's when heading into 2001, God forbid, Cisco for the first time in years missed their earnings estimate by a penny and had the temerity to issue negative guidance. And then the game was over. Had nothing to do with the Fed, had nothing to even do with the economy. Had to do with the fact that these lofty valuations that all of a sudden investors realized, oops, I paid way too much. There's too much price in these stocks relative to the earnings they're going to deliver. And that was the news that made the market. So, as Herbstein famously said, Richard Nixon's chief economist back in the 70s and Ben Stein's father, remember Ben Stein? Bueller? Famously said, anything that can last forever by definition won't. Nobody can time these things. We just have to be reasonable and respect probabilities, and respect the ranges of what is extreme at both ends. And I'd say that right now, you have a tremendous amount of confidence in these high-flying tech names. Now, it's not being shared in other parts of the market. The S&P equal weight has lagged well behind. You have lots of value stocks that are just languishing. Look at the regional banks. What are they doing? Look at what the home building stocks have been doing recently, even increasing segments of the retail space. It's not a universal stock market, right? It is really as bifurcated today as it was back when you had this value. I mean, look what's happened between the Dow and the S&P and the NASDAQ. It looks a lot like what happened back in 1999. So, I would just say that, what happens on the other side is when you start getting the outflows, then you're going to get the forced selling. You're going to see the movies. This is what happens on the other side of the mountain that nobody sees because everybody is just talking about what you're talking about, which is, well, the market for like the 8th day in a row just set a new high. We're 5,500. And then you have people, this guy is calling for 6,000. He may well end up being right. But,
Right.
Just for me, it's like I'm at the circus watching the clown blow up the balloon and the balloon's getting bigger. You see, that's how I'm looking at this. The balloon is getting bigger until it pops because this is a gigantic price bubble. It's not a bubble in how this is going to affect the economy. The internet was a massive game changer globally, but it was a massive financial asset price bubble. And it's amazing to me. It shows you how old I am that most people don't hardly even remember the late 1990s. But nothing is ever 100% the same, but it looks a lot like that cycle to me.
Yeah.
And so what happens is that when the selling starts and the index selling starts, if it's going to become a reinforcing tailspin to the downside, the momentum will just basically shift. The fund flow momentum will shift from what's happening today on the upside. It's going to look like a mirror image. And that's what nobody really quite understands. They'll be sitting there thinking, like, what's going on here? But you see, the selling momentum from the index funds is going to cause things to go to crazy low levels that they can't even imagine right now. But that's what a bear market is, right? That's what a bear market is. A bull market is an escalator going up, and a bear market is an elevator going down. But everybody believes, remember Chuck Prince back in 2007? You got to stick around until the music stops. Stick around until the music stops. The problem is that when the music stops, after a bull market like this, it's an elevator down, and you won't be able to get out fast enough. And once again, I tell this because the thing is that I am also an economic and financial historian. I go through this because I am generally conservative. I am generally risk averse. I always look at returns, risk adjusted, maybe because I was brought up by Depression era parents. However, I don't believe, despite everything I'm saying, that capital preservation ever goes out of style. But I've seen these cycles before, and nobody's going to be able to time it for you, except that I see this ending pretty badly. I just can't tell you when. I'm just not willing to participate. I'm willing to clip my coupon. It could be in the single A corporate credit market, in treasuries, in money market, and in select areas of the stock market that I feel will not get killed. Okay, but for people that think that we are in some sort of new paradigm, new era, let me tell you something. The headlines were just dominated with that when it came to technology back in 1999, 2000. And when it came to the democratization of finance and housing, when I was at Mother Merrill in 06 and 07. And of course, because people they look at the pricing and then they say, I got to build a narrative around the pricing to justify my long position in these ultra expensive names. And so we're just reliving history.
Yeah.
And, but I'm not going to bite because I have a long fuse. I'm a patient investor, and I don't tend to follow the Pied Piper. So yeah, I'm like I said, I'm the kid at the circus watching the clown blow up the balloon, and it's getting bigger and bigger by the day and by the week until it doesn't. And by the way, when the music stops, as Chuck Prince found out in real time, it's not just that the music stops; it's that the movie runs in reverse. That's what happens.
I remember it well, David, and this is one of the reasons why we're so happy to have you on this program to be able to share those insights and this decades of history watching this. I remember when I was one of the young guys on Wall Street at Credit Suisse, a few blocks in that direction, and the market imploded when I thought it was going to last forever. And I think I spent a couple of years living in my mother's basement after that.
Well, I heard that her cooking is really good, and she did your laundry, so not a bad deal.
Yes, she did. You are correct on both. By the way, just a quick statistic here to throw out. S&P 500 performance year to date, 15.8%. Equal weighted S&P 500 performance year to date, 4.5%.
That just about says it all. It is no matter how you look at it, Mag 3 versus the other 497. What you mentioned before, between equal weight, cap weight, value growth, the Dow versus the NASDAQ, all these things. We're hitting two standard deviation events on a lot of these bifurcations. And when you hit a 2 sigma event, you sort of want to sit back and say, like, what exactly is going on here? And so the old adage, if it's too good to be true, it probably is. And we're really talking about financial asset pricing. We're not talking about whether or not generative AI is going to have a huge impact. We're not talking about dilapidating productivity. We're not talking about anything else. We're talking about this is what markets do. Markets are driven by classic John Maynard Keynes, the extremes of two emotions, fear and greed. Fear and greed. The word animal spirits was never related to GDP. It was related to S&P, animal spirits, which is sentiment and psychology. But when it gets to extremes, if you're not careful, it can run you into trouble. And so what I see, as you just mentioned, bifurcation and concentration extreme, valuation extreme, sentiment extreme, and I say two things. Either start taking profits and rebalance your portfolio, or at least have the discipline to sell calls against your portfolio. You don't want to sell your portfolio. You fall in love with it. You have this emotional attachment, at least while the time that insurance is so low. Buy some calls. That's my recommendation.
David, I couldn't think of a better place to end it than that. Thank you so much for your time. Great conversation, as always.
Okay, Ash, great talking to you. Looking forward to seeing you again soon.
Looking forward to it. Thank you so much for watching, everyone.
It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that, all in one place, in Singapore. What more can you ask? See you at TOKEN2049.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.